Hello, I'm David Frazier, the founder of Investors Monitor and the president and chief market strategist for Frazier and Mayer Research, LLC, our independent investment research firm. This is the second in a series of new videos that we plan to record every week regarding factors and developments that are likely to affect the worldwide financial markets and, more importantly, the values of our watchers, viewers, listeners, independent financial market portfolios. Well, in last week's video, I said that our research indicates that stock prices around the globe, or at least in major regions of the world, will continue to trend higher during the first half of 2018 after rising considerably during 2017. And we're off to a good start. For example, the Dow Jones Industrial Average rose by 577 points during just the first 4 days of trading during the new year. Meanwhile, the S&P 500 index rose during the first week of trading by 2.6%, and the NASDAQ Composite Index rose by 3.4%. just during the first 4 days of trading during 2018. And I'm not surprised at all. I mean, I said last week, not only do I and my firm expect stock prices to continue to trend higher during the first 6 months of 2018, but the readings on our short-term investment timing indicators last week indicated that stocks would continue to move higher during the first the week of the new year, and it's that's exactly what happened. Now, what was behind those increases? Well, I think primarily it's just what's been behind the sharp rises in stocks over the past year, and that is people here in America as well as abroad in major regions of the world feel very good about what's going on in their country's economies. The economic conditions have improved substantially over approximately the past 18 months. The employment situation's improved considerably. And as an example, or a few examples of some very recent economic developments, automatic data processing, which provides payroll management services for thousands of businesses in the United States, reported last Thursday, that was January the 4th, that employers, private sector employers that is, created the most new jobs during December since March of 2017. Meanwhile, on that same day, the Conference Board, which is an independent economic research firm, that's primarily what they do, reported last Thursday, January 4th, that U.S. employers posted the largest number of job advertisements on internet websites since October 2016. Well, what does that mean? Well, it's pretty simple. There's an extremely high correlation between what happens in the employment markets a few months into the future and the number of job advertisements that employers post on internet websites or in newspapers also, but just the number of job postings. And of course there is. I mean, employers are not going to increase their number of job advertisements unless they expect to increase the size of their workforce, to do more hiring. So based on those numbers from the Conference Board, where once again, the U.S. employers posted the largest number of job ads during December of 2017, this past December, since October 2016, well, there's a really, really good chance of extremely high probability that even a larger number of new jobs, at least private sector jobs, will be created during January and February than were recorded last month in December. Now, on Friday of last week, January 5th, the U.S. Department of Labor reported that the number of non-farm payrolls non-farm jobs, that is, that were created during December, rose fairly modestly during December, increasing by only 148,000 new jobs. However, that was due primarily to big job cuts in the low-paying retail sector of the economy. In contrast, a very large number of jobs were created in relatively high-paying industries such as the construction, manufacturing, education, healthcare, and professional business services industries. So on average, overall, the report from Automatic Data Processing, the Conference Board, and the U.S. Department of Labor indicates that the employment situation here in the United States continued to improve during December and will likely continue to improve over the next couple of months. That's obviously very, very significant and very positive. I mean, if employers create more jobs, therefore the large number, percentage of the population therefore has jobs, well, there's probably going to be more saving and investment and spending. Businesses therefore will be able to report higher revenues and likely higher profits, and stock prices are ultimately determined by corporate profits. So these are very positive developments, meaning the improvements in the manufacturing sector, not here only in the United States, but in Japan, the Eurozone, Brazil, China, and India. And manufacturing activity in the United States and the Eurozone, as well as Japan, actually accelerated during December. Just didn't increase, but accelerated versus the prior few months. So let's move on to the recent trading action in the U.S. stock market, and I'm going to pause here just for a moment because what I'm going to do, is to show you some charts of that illustrate the trading action in the U.S. stock market during the past week. Okay, so let's continue. Well, first, let's look at a chart of the Dow Jones Industrial Average. And of course, I'm sure everyone listening to this video realizes that the Dow was up sharply last year. I mean, a strong upward performance here. But what's really positive is that this is a weekly chart, by the way, of the Dow Jones Industrial Average. Last week, we see that volume increased substantially versus the prior week. Now, first of all, let me say that that's pretty normal during the first week of a new year versus the ending week of the prior year, because during the Christmas to New Year holiday break, a lot of people are out of town, on vacationing, relaxing, spending time with family and friends. So there tends not to be much trading during the final week of any year. But regardless, the fact that it increased fairly substantially is a positive development. And we had a fairly sharp move up here, 577 points the Dow increased during the first 4 days of 2018. As did the S&P 500 index. You see volume was up, moved up fairly sharply, up 2.6% for the week. And the NASDAQ Composite Index, volume of trading was also up. And the NASDAQ rose fairly sharply, up 3.4% rounded off for the week. Also, the industrial sector was up fairly sharply last week, as you can see here, the Dow Jones Industrials. So that's very, very positive. Good start to the new year. Let's now go take a look at some internal indicators for the overall U.S. stock market. And what I'm going to go to specifically is the advanced decline line. Many of you probably are well aware of what this statistic is, but some of you might not be. I'm going to go to a daily chart. And an increasing number of stocks rose last week versus those that declined. So it wasn't just the broad stock market indices, but for the New York Stock Exchange, that is stocks that trade on the New York Stock Exchange, there were a larger number of stocks that moved up in price and then moved down in price, the cumulative advanced decline line. And many of you know that's what we want to see. We don't want to just see the broad indices increase, but we want to see overall more stocks increase in price than decline. And the same was true with the advancing volume to declining volume. You can see, that was also continued to move higher last week. Very positive development. Lastly, I feel like there's one other thing. Yes, the number of stocks trading above their 200-day moving average also were pretty flat last week. So these are positive developments. However, now I'm going to take you to my firm's internet website at also called Investors Monitor, at investorsmonitor.com, and we're going to go to the timing monitor. And first of all, we're going to take a look at my buy-sell index. Some of you that have been with us for a while are very familiar with this, but a lot of you might not be. And this is based on a certain number of leading economic indicators that I created during 1986, and just studying for many months the correlations between different economic statistics and the stock market. And so this is what we call our buy-sell index, and the B's are meaning telling us to buy to get into the overall stock market. Sell is telling us to sell to get out of the market. And if you go through this, you'll see that this index overall is very reliable. It's not perfect, but here you would have gotten out at higher prices than you got in. You would have here about broke even, but here you would have gotten in near the bottom and sold at this level. You would have sold too early there because you would have gotten back in here, but you would have avoided completely the 2008 to 2009 downturn and would have gotten in very near the low. And this proprietary indicator gave its latest buy to get back into stocks, 100% into stocks during February of 2016. And these red bars, once it reaches 40%, that's a sell. That means get out. Well, we're nowhere near that. So, hey, this is indicating that stocks in general are going to continue to move higher during the months ahead. So now let's go to our the sector relative performance. How have stocks of companies that operate in the United States 10 major economic sectors, how are they doing? Not just what are the economic developments indicating, but what's actually going on in the market. And we see here, well, over the past 6 weeks, the best performing sector were industrial stocks, followed by basic materials, energy, consumer discretionary. This is very, very positive because these are cyclical sectors of the market, whereas the worst performing were the defensive sectors, utilities, telecom, healthcare. This is what we want to see. We want to see we want to see stocks of companies in these cyclical sectors perform much better than during the defensive sectors. And that's exactly what happened over the past 6 weeks. And by the way, we update those charts every 6 weeks on our internet website. Not every 6 weeks, every week on Sunday of every week on our internet website. However, our sector performance index, which I'm not going to get into the details, but it's using the performance of these same sectors, is showing us that the momentum slowed last week and moved lower, suggesting that stocks will probably continue to move up a little bit over the next couple of days, but then likely move down a bit during the second half of the week of January 8th to the 12th. And by the way, I put comments at the bottom of all these charts so you can at least see what our thinking is. Next, let's just go to one more. Well, we'll go to both these other two. Our stock high relative price strength index. This is an index composed of the stock market leaders since the major bull market began during March of last year. As I told our listeners last week, I would argue that bull market actually ended during July of 2014, and this was a very modest bear market, and that a new bull market did not begin until February of 2016. So I would argue that we're in the very early stages of a new bull market that's a subset of this overall bull market. But this relative price strength index, it actually it's pretty flat last week. It's suggesting that stocks might be peaking on a very short-term basis. Once again, as I said a moment ago, we always provide some comments here on our website regarding these charts. And lastly, let's look at our overbought, oversold indicator, which is a very short-term stock market timing indicator. And last week, this indicator rose to its highest level possible. And if you look closely and study this chart, look at the correlation between this blue line, which is our overbought, oversold indicator, and the black line, which is the S&P 500 index, you'll see that for the most part, when it gets up in this level, and especially when it gets up near 100, that the S&P 500 tends to move lower. And just the opposite. When it gets to very low levels, then the S&P 500 index tends to rebound and move higher. So with this index last week closing out at the highest level possible, my thinking is stocks are going to move a bit lower during the week of January 8th to the 12th. Let's do one more thing. It's not really related to what I'm talking about, but those of you that decide to go to our internet website, something else that can be very telling in what's going on in the overall U.S. stock market is our industry monitor. And we'll take a look at for the week into January 5th. And what we show is the relative performance of stocks of companies in 197 different U.S. industries and how those stocks in those industries performed relative to stocks in other industries. So the best performing industry over the past 6 months for the week into January 5th was the energy and coal sector. But I'll let you go through this on your own. The green means that this sector moved up in rank versus the prior week. But I encourage you to go here and keep up with this. This can really give you a good idea of what's going on the overall market. So I'm going to wrap this up in just a moment, but I'm going to pause again before doing so. So let's just pause right there for a moment. By the way, once again, our internet website, investorsmonitor.com. We update this daily with important developments that are going on in the market. So I encourage you to visit our internet. Okay, well, that's it for this week. If you'd like to keep up with more detailed factors and developments that affect the financial markets and that will likely affect your investment portfolios, as well as to invest in the right sectors of the market at the right time, as well as in individual stocks, I encourage you to try one or more of our investment journals. We have 2 journals. One is a somewhat conservative journal. The name of it is Frazier's Strategic Allocator, obviously named after me, David Frazier. And that investment journal really focuses to a large degree on helping subscribers to preserve the value of their portfolios, as well as, of course, to make gains overall to at least keep up with inflation and really outdo inflation, to grow their portfolios, but a large emphasis on helping people to preserve the value of their portfolio. There are 3 model portfolios that we cover in that investment journal: a growth and income portfolio, an income portfolio only, that is a fixed income portfolio, and a speculative portfolio. You can read about it on the subscription page of our website at investorsmonitor.com. Our other service focuses almost entirely on small cap growth stocks of companies that we expect to increase in price by between 10 and 30% in a 3-month period. Yes, only 3 months. We've done that many times in the past. And then increase by 50% to over 100% in a 12-month period. That's called Frazier Strategic Allocator. You can subscribe to either of those services by clicking on a link underneath the description of this video, right underneath the video box on YouTube. And there's a link that will take you directly to our subscription page. You can try our Frazier Strategic Allocator for only $79 for the next 3 months, and our Frazier's Exponential Growth Opportunities for only $99 for the next 3 months. I think I'm going to leave it at that. Wrap it up by saying thank you for listening and watching, for tuning in. We'll provide you with another video on the overall market next Sunday, and we'll do so every week. And also beginning next weekend, that is on the 14th of January, we plan to start also producing weekly videos on individual stocks. We'll focus entirely on stocks. So I thank you for tuning in, and I'll speak with you again next week.